Smart Investing for Beginners. How to Make Your Money Work for You. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Most people believe investing is complicated, risky, or something only the wealthy can afford to do. They assume you need a finance degree, a stockbroker, or a small fortune to get started. But what if I told you that investing is actually simple, safe, and accessible to everyone, including you? The biggest mistake people make with money isn't choosing the wrong stock or investing at the wrong time. It's waiting too long to start. Every day you delay is another day lost to the power of compound interest, the force that turns small, consistent investments into massive wealth over time. You don't need thousands of dollars to begin. You don't need to monitor stock charts or predict market trends. What you need is a plan, a long-term mindset, and the willingness to take the first step. This book will show you exactly how to do that. You'll learn how to build wealth without stress, choose the best investments for beginners, and avoid costly mistakes that trip up so many new investors. Most importantly, you'll discover that investing isn't about luck, it's about strategy, discipline, and time. If you've ever felt intimidated by investing, this book will break it down into simple, actionable steps that anyone can follow. You'll learn how to start with as little as $50, make your money work for you, and create long-term financial security without obsessing over the stock market. By the time you finish this book, you won't just understand investing, you'll be doing it. Because the truth is, the best time to start was years ago. But the second best time, it's right now. Chapter 1. Why investing feels scary and why it shouldn't. Most of us grew up hearing that investing is risky, complicated, and best left to experts. Maybe you've watched the stock market crash on the news or heard horror stories of people losing everything. It's easy to think, what if I mess up and lose all my money? That fear is real, but it's also keeping you from something powerful, your financial future. Let's be clear. Investing does involve risk, but so does doing nothing. Every day you wait, inflation eats away at your savings. $1 today won't buy as much in the future. By not investing, you're actually losing money over time. The good news? There's a way to grow your money safely, and it's not as hard as you think. Most beginners assume you need a finance degree or thousands of dollars to start. That's a myth. Investing is more about consistency than cash. Imagine two people. One starts investing $100 per month at age 25. The other waits until 35 but invests twice as much, $200 per month. Who ends up with more at retirement? The first one, by a long shot. That's the magic of compound interest. The earlier you start, the more your money multiplies. Think of it like planting a tree. The best time to plant one was 20 years ago. The second best time is today. Even if you start small, time does the heavy lifting. The key is to get started. Maybe you're still hesitant. What if you invest at the wrong time? What if there's a market crash? Here's the truth. The stock market has always gone up over the long run. There have been crashes, recessions, and even depressions. Yet every single time, the market has recovered and reached new highs. If you invest wisely and stay the course, history is on your side. The biggest mistake new investors make isn't picking the wrong stock, it's never starting at all. Fear makes people freeze. They wait for the perfect time, but that time never comes. Meanwhile, their money sits in a bank account, earning little to no interest. The reality is, you don't need to time the market, you just need to be in it. You might wonder, what if I don't know what to invest in? That's a valid concern, but here's the simple answer. Start with broad, low-cost index funds. These funds spread your money across hundreds of companies, reducing risk and increasing long-term growth. You're not betting on one company, you're betting on the economy itself. Another common fear is losing everything overnight. The truth. That only happens if you put all your money in one place or panic sell during a downturn. Smart investors diversify, meaning they spread their investments across different assets. That way, even if one investment struggles, others balance it out. So how do you start? First, commit to the mindset that investing isn't a gamble, it's a strategy. Second, understand that small steps matter. You don't need to throw in thousands of dollars right away. Even $50 a month can set you on the path to wealth. Third, focus on long-term success. Wealth isn't built overnight, but it is built over time. Right now you have a choice. You can let fear stop you, or you can take control of your financial future. The hardest part isn't investing, it's making the decision to start. Once you do, everything else becomes easier. In the next chapter, we'll dive into the exact strategies that help beginners build wealth without stress. You'll learn how to make your first investment, where to put your money, and how to set yourself up for long-term success. By the time you're done, you won't just understand investing, you'll be doing it. Chapter 2. The simple strategy to build wealth, even if you start small. Most people believe wealth is only for those who inherit money, earn six figures, or take huge risks. But here's the truth. Wealth is built through small, consistent actions over time. You don't need to be rich to invest, you need a plan. The key is to start early, stay consistent, and let time work in your favor. Imagine two friends, Sarah and Jake. Sarah starts investing $200 a month at age 25. Jake waits until 35, but invests twice as much, $400 a month. Who ends up wealthier at retirement? It's Sarah, by a landslide. Even though she invested less overall, her money had more time to grow. That's the power of compound interest. Your money doesn't just grow, it multiplies on itself. Many beginners believe they need to find the perfect investment to succeed. The truth? It's not about picking winners, it's about consistency. The best investors don't try to time the market or chase trends. They invest a set amount regularly, no matter what's happening in the economy. This strategy, called dollar cost averaging, means you buy more shares when prices are low and fewer when prices are high. Over time, this smooths out market ups and downs. You might wonder, where should I put my money? The best place for beginners is low-cost index funds. These funds spread your money across hundreds of companies, making them safer than betting on individual stocks. The S&P 500 index, for example, has grown by an average of 8 to 10% per year over the long run. Instead of trying to outsmart the market, you simply own the market and let it grow. Another key to building wealth is automating your investments. The less effort it takes, the more likely you are to stick with it. Set up automatic transfers to your investment account each month, just like a bill you always pay. By treating investing as a non-negotiable expense, you remove emotion from the process and stay consistent. You might think, but what if I don't have extra money to invest? The truth is, you don't need a lot to start. Even $50 a month makes a difference. The key is to make investing a habit. As your income grows, you can increase your contributions, but the most important step is starting now. Some people delay investing because they fear losing money. The reality is, the stock market does go up and down in the short term, but over decades, it has always increased in value. If you stay invested, downturns don't hurt you, they help you. Why? Because when prices drop, you're able to buy shares at a discount. Instead of fearing market dips, long-term investors see them as opportunities. Building wealth isn't about luck or finding secret stock tips. It's about playing the long game. The best investors don't jump in and out of the market. They set a plan, stick to it, and trust the process. This doesn't mean you have to sacrifice your lifestyle today. It simply means prioritizing your future self by setting aside money to grow. Even small contributions now can turn into hundreds of thousands of dollars later. The longer you wait, the harder it is to catch up. If you do one thing after this chapter, make a commitment. Open an investment account, set up automatic contributions, and start right now, even if it's just a small amount. Future you will thank you. In the next chapter, we'll explore the best investment options for beginners. You'll learn exactly where to put your money and how to build a strong, diversified portfolio without stress. Chapter 3. The 3 best investments for beginners and how to pick the right one for you. With so many investment options out there, it's easy to feel overwhelmed. Stocks, bonds, real estate, crypto. Where do you even begin? The truth is, you don't need dozens of investments to build wealth. You just need the right ones. Instead of chasing trends or gambling on risky stocks, focus on 3 simple, proven investments that are beginner-friendly and effective. The first and most powerful investment for beginners is index funds. These funds allow you to invest in hundreds of companies at once, reducing risk while still earning strong returns. The S&P 500, for example, has historically returned 8 to 10% per year. Instead of picking individual stocks, you own a piece of the entire market. It's like betting on the success of the economy itself, rather than one company. The best part? Index funds require zero effort. They're set and forget investments that grow over time. The second smart investment is exchange-traded funds, ETFs. ETFs are similar to index funds but trade like stocks, giving you more flexibility. Many ETFs track major indexes like the S&P 500 or the total stock market. The key benefit of ETFs is that they often have lower fees than traditional mutual funds, meaning more of your money stays invested. If you want a simple way to grow wealth without active management, ETFs are a great choice. The third option every beginner should consider is retirement accounts like a 401k or IRA. These accounts offer huge tax advantages, helping your money grow faster. A 401k is an employer-sponsored plan where your contributions are often matched. This is free money you should never ignore. An IRA is a personal retirement account with tax benefits that allow your investments to compound efficiently. If you're serious about long-term wealth, maxing out these accounts should be a top priority. You might wonder, which of these investments is best for me? The answer depends on your goals. If you want long-term growth with minimal effort, index funds are ideal. If you prefer a little more flexibility, ETFs give you control while keeping costs low. If you want tax advantages and retirement security, a 401k or IRA should be your focus. The best strategy? Use a mix of all three. A big mistake new investors make is chasing hot investments like crypto, penny stocks, or meme stocks. These might seem exciting, but they come with huge risks and often end in losses. The most successful investors don't gamble, they invest in assets that have proven themselves over decades. The goal isn't to get rich overnight. It's to build wealth steadily and predictably. Another key to smart investing is diversification. This means spreading your money across different investments so no single loss can wipe you out. Index funds and ETFs do this automatically by holding hundreds of stocks at once. Even if one company fails, the impact is minimal. This is why index investing consistently outperforms stock picking over the long run. Some people hesitate to invest because they think they need a lot of money. But thanks to fractional shares, you can start with as little as $10. Many investment apps let you buy small portions of an index fund or ETF, making investing more accessible than ever. The key isn't how much you invest, it's that you start and stay consistent. If you're still unsure, keep it simple. Start with a low-cost index fund, contribute regularly, and let time do the work. The hardest part is taking the first step, but once you do, you'll see how easy it is to grow your wealth. In the next chapter, we'll dive into the power of compound interest and how it turns small investments into massive wealth over time. Chapter 4. The power of compound interest, how your money grows while you sleep. What if I told you that your money could work harder than you ever could? That's the magic of compound interest, the most powerful force in investing. It's how small investments today turn into life-changing wealth in the future. If you understand this concept, you'll never look at money the same way again. Most people think wealth comes from high salaries, lucky stock picks, or business deals. In reality, time and consistency create the biggest fortunes. Compound interest means you don't just earn money on what you invest, you earn money on your earnings. It's interest on interest, and over time, it creates exponential growth. Let's break it down. Imagine you invest $200 a month into an index fund with an 8% average return. In 5 years, you'll have about $14,700. In 10 years, that grows to $36,500. But here's where it gets interesting. After 20 years, your investment balloons to $118,000. And after 30 years? A staggering $300,000 plus. You only contributed $72,000, but your money more than quadrupled, without you doing anything extra. The secret is starting early. The longer your money stays invested, the more time it has to grow. Two people, Emma and Jake, each invest $200 per month. Emma starts at 25 and stops at 35, investing for just 10 years. Jake waits until 35 but invests until he's 65. Even though Jake invests for 3 times as long, Emma still ends up with more money. Why? Because her money had an extra decade to compound. Starting early is more powerful than investing more later. But what if you didn't start early? The next best time is right now. The longer you wait, the harder it is to catch up. Investing just $50 a month today is better than waiting until you have more money later. Time matters more than the amount. Some people try to outsmart the market, jumping in and out based on trends. That's a mistake. The stock market goes up and down, but over time, it always trends upward. The best strategy? Stay invested, keep contributing, and let compounding work for you. It's also crucial to reinvest your earnings. Some investments pay dividends, profits companies give to shareholders. Instead of spending these, reinvest them. This boosts your compounding effect even more. Over decades, reinvesting dividends can turn a good investment into an incredible one. A common fear is, what if the market crashes? Market drops actually create buying opportunities. If you keep investing during downturns, you get more shares for the same price. When the market recovers, your gains are even bigger. Compounding doesn't stop during a crash, it accelerates when prices rebound. You might be wondering, where do I start? The simplest way is with low-cost index funds. They provide steady growth over time, allowing compounding to work at full force. The key is to invest automatically. Set up recurring contributions, so you're always building wealth, no matter what. Most people underestimate how powerful compound interest is. They think small investments won't matter. But wealth isn't built in days, it's built in decades. Even modest investments can turn into millions, if given enough time. If you take one thing from this chapter, let it be this: start investing now. Don't wait for the perfect time. Even small amounts today can create financial freedom tomorrow. In the next chapter, we'll cover the exact steps to make your first investment and start growing your wealth today. Chapter 5. The smartest way to start investing even if you have $50. Most people believe they need thousands of dollars to start investing. That's simply not true. Thanks to modern technology and new investment options, you can start with as little as $50. The key isn't how much you invest, it's getting started and staying consistent. Many beginners delay investing because they feel unprepared. They wait until they earn more money, have a better understanding, or feel ready. The truth: you'll never feel 100% ready, and the longer you wait, the more money you lose in potential growth. Time in the market beats timing the market. Even small amounts invested today will outperform larger amounts invested years later. So, where should you put your first $50? The best option is a low-cost index fund or ETF. These funds track the stock market, giving you instant diversification without the risk of picking individual stocks. The SP 500 Index Fund, for example, includes 500 of the biggest companies in the US, meaning you're investing in the entire economy rather than betting on one company. To start, you need a brokerage account. Platforms like Vanguard, Fidelity, or Charles Schwab allow you to invest with no account fees. If you prefer an app-based option, platforms like Robinhood, M1 Finance, or Acorns make it easy to get started. Many of these platforms allow fractional investing, which means you can buy small pieces of expensive stocks or funds. Once your account is set up, the smartest approach is dollar cost averaging, DCAA. This means you invest a fixed amount at regular intervals, whether the market is up or down. Instead of worrying about the perfect time to invest, DCA ensures you build wealth steadily over time. If you set up automatic investments, you remove the guesswork entirely. A common mistake beginners make is chasing hot stocks. You've probably heard about people making big money on Tesla, Amazon, or the latest cryptocurrency. But picking individual stocks is risky, and most people lose money trying to time the market. The most successful investors don't chase trends, they invest in broad, diversified funds and let time do the work. Another smart move is taking advantage of tax-advantaged accounts like a 401k or IRA. If your employer offers a 401k match, contribute enough to get the full match, it's free money. If you don't have a 401k, opening a Roth IRA is a great alternative. These accounts allow your money to grow tax-free, which means you keep more of your returns. If you're starting with just $50, don't feel discouraged. The most important thing is building the habit. If you invest $50 this month, try increasing it to $100 next month. Over time, as you earn more, you can scale up your contributions. The key is starting small and staying consistent. Some people worry about market crashes. What if you start investing and the market drops? It's important to remember that the market has always recovered. History shows that every major downturn has been followed by new highs. Instead of panicking, smart investors keep investing during downturns because lower prices mean more shares for the same amount of money. The hardest part of investing is taking the first step. The good news is, you've already learned the basics. Now, it's time to take action. Open your account, invest your first $50, and set up automatic contributions. In the next chapter, we'll discuss the 5 biggest investing mistakes and how to avoid them, so you can maximize your gains and build long-term wealth with confidence. Chapter 6. The 5 biggest investing mistakes and how to avoid them. Investing is one of the best ways to build wealth, but beginners often make mistakes that cost them thousands of dollars. The good news: most of these mistakes are avoidable if you know what to watch for. The goal isn't to be perfect, it's to avoid costly errors that slow your progress. Here are the 5 biggest mistakes new investors make and how you can stay ahead. The first mistake is trying to time the market. Many beginners wait for the perfect time to invest, thinking they'll jump in when stocks are low and sell when they're high. The problem? No one can predict the market. Even professional investors fail at timing it consistently. Instead of waiting, use dollar-cost averaging, which means investing a fixed amount regularly, no matter what the market is doing. This strategy helps you buy at both highs and lows, averaging out your cost over time. The second mistake is investing without diversification. Some beginners put all their money into one stock or sector, hoping for big returns. But if that investment fails, they lose everything. The best way to reduce risk is diversification, spreading your money across different assets. The easiest way to do this is by investing in index funds or ETFs, which give you exposure to hundreds of companies at once. This way, even if one company struggles, your overall portfolio remains strong. The third mistake is paying high fees. Many people don't realize that small fees can eat away at their returns. Some mutual funds and investment advisors charge 1% or more in management fees, which may not seem like much but can cost you hundreds of thousands of dollars over a lifetime. Instead, choose low-cost index funds and ETFs, which typically have fees under 0.1%. The less you pay in fees, the more of your money stays invested and grows. The fourth mistake is letting emotions drive decisions. When the stock market drops, fear causes many investors to panic and sell. When stocks rise, greed makes people buy at inflated prices. Successful investors don't let emotions dictate their actions. Instead, they stay focused on long-term growth. The market will always have ups and downs, but history shows that patient investors who stay the course come out ahead. The best strategy? Stick to your plan, no matter what's happening in the market. The fifth mistake is not taking advantage of tax-advantaged accounts. Many new investors overlook 401ks, IRAs, and Roth IRAs, missing out on massive tax benefits. If your employer offers a 401k match, contribute enough to get the full match, it's free money. If you don't have a 401k, open an IRA. These accounts allow your investments to grow tax-free or tax-deferred, meaning you keep more of your earnings over time. Avoiding these 5 mistakes will set you up for success. You don't need to be a financial expert, you just need to follow simple, proven strategies. Stay consistent, keep fees low, ignore short-term noise, and take advantage of every tax benefit available. Now that you know what not to do, it's time to focus on what works. In the next chapter, we'll cover how to invest without watching the stock market every day so you can build wealth with less stress and effort. Chapter 7. Stock Market Secrets: How to Invest Without Watching the News Every Day. Many beginners believe successful investing requires constant monitoring of stock prices, financial news, and market trends. The truth: you can build wealth without watching the stock market daily or stressing over short-term fluctuations. The best investors aren't glued to their screens, they set a strategy and let time do the work. The first secret to stress-free investing is owning the entire market instead of picking individual stocks. Buying a single company's stock is risky. If that company struggles, your investment suffers. But when you invest in an index fund, you're buying hundreds of stocks at once, spreading risk across the entire economy. The S&P 500, for example, holds 500 of the biggest U.S. companies. Even if some struggle, others will grow, keeping your investment strong. The second secret is automating your investments. Instead of deciding when to buy, set up automatic contributions to your investment account. This ensures you invest regularly without needing to think about it. Dollar cost averaging. Investing a set amount consistently removes emotion from investing and keeps you on track, regardless of market conditions. Another key is ignoring short-term market noise. News headlines are designed to grab attention, not help you make smart financial decisions. If the market drops, the media often makes it sound like disaster is imminent. But history proves otherwise. Every major market downturn has been followed by new highs. If you panic and sell, you lock in losses instead of benefiting from the recovery. Long-term investors win by staying the course. Successful investors also understand the power of patience. The stock market rewards those who do nothing most of the time. Constantly buying and selling rarely leads to better results. Instead, set it and forget it. Invest in a diversified fund, keep adding money, and let compound interest do the heavy lifting. Another secret is keeping fees low. Many mutual funds and financial advisors charge high management fees, which quietly eat away at your returns. Instead, choose low-cost index funds with expense ratios under 0.1%. Over decades, this small difference can save you hundreds of thousands of dollars. Some investors worry about market crashes and try to time when to buy or sell. The reality is, no one can predict the market consistently. Instead of trying to outsmart it, invest consistently. When the market drops, think of it as a sale. Stocks are cheaper, and your money buys more shares. The best investors embrace downturns as opportunities, not threats. If you want investing to be simple, focus on 3 key principles: invest in a diversified index fund, automate contributions, and ignore daily market movements. These steps remove stress and let you focus on life instead of obsessing over stocks. Investing shouldn't feel like a full-time job. You don't need to check prices daily or react to headlines. Wealth is built over decades, not days. The less you micromanage your investments, the better they'll perform. Now that you know how to invest without stress, the next chapter will teach you how to use retirement accounts to grow your money even faster, while paying less in taxes. Chapter 8. Retirement Accounts 101: Why a 401k or IRA could make you a millionaire. Most people think of retirement as something far off, but the choices you make today will determine your financial future. The good news? You don't have to be rich to retire comfortably. Thanks to 401ks and IRAs, you can build wealth automatically while paying less in taxes. These accounts are the fastest way to grow your money without extra effort. A 401k is an employer-sponsored retirement account that allows you to invest before taxes are taken out of your paycheck. Many employers even offer a 401k match, meaning they give you free money just for contributing. If your employer matches contributions, always contribute enough to get the full match. It's an instant 100% return on investment. If you don't have a 401k, the best alternative is an individual retirement account IRA. Unlike a 401k, an IRA isn't tied to your job, and you can open one yourself. There are 2 main types: traditional IRAs and Roth IRAs. A traditional IRA works like a 401k, where you contribute pre-tax money and pay taxes when you withdraw later. A Roth IRA is the opposite. You pay taxes up front, but your money grows completely tax-free. So which is better? If you expect to be in a higher tax bracket later, a Roth IRA is the best choice because withdrawals are tax-free. If you expect to be in a lower tax bracket in retirement, A traditional IRA may be better because you get tax breaks now. Either way, using these accounts helps you build wealth faster. The real magic of retirement accounts is compound interest. Let's say you invest $500 per month into a 401k or IRA with an 8% average return. In 10 years, you'll have about $91,000. In 20 years, that grows to $274,000. After 30 years, you'll have $745,000. That's nearly $750,000 just from investing consistently. Some people hesitate to invest in retirement accounts because they don't want their money locked up. While it's true that withdrawing early comes with penalties, these accounts are designed for long-term growth. If you keep dipping into your investments, you'll never build real wealth. The best strategy is to contribute what you can afford to leave untouched and let it grow. Another key benefit of retirement accounts is tax efficiency. When you invest in a regular brokerage account, you pay taxes on your earnings each year. But with a 401k or IRA, your money grows tax-free until you withdraw it later. This allows your investments to compound much faster than they would in a taxable account. If your employer offers a Roth 401k, it's worth considering. This account works like a Roth IRA, but has a much higher contribution limit. If you can contribute to both a Roth 401k and a Roth IRA, you'll maximize tax-free growth, setting yourself up for a stress-free retirement. Many people think saving for retirement means sacrificing their lifestyle today. But in reality, investing in a 401k or IRA is one of the easiest and most painless ways to build wealth. Since contributions are automatically deducted from your paycheck, you won't even notice the money is missing. The key is to start as early as possible so you can take full advantage of compound growth. If you take one thing from this chapter, let it be this: start contributing to a retirement account now. Even small contributions will grow into life-changing wealth over time. Now that you know how to maximize tax-advantaged accounts, the next chapter will cover the psychology of investing, how to stay consistent, avoid emotional mistakes, and build long-term wealth with confidence. Chapter 9. The psychology of investing, how to stay consistent and beat fear. Most people assume investing is all about numbers, charts, and strategies. But the biggest factor in your success isn't what you invest in, it's how you think. Your mindset determines whether you stay consistent or panic when the market drops. Mastering the psychology of investing is just as important as choosing the right investments. The first challenge is fear of losing money. Watching your portfolio drop can feel terrifying, but market downturns are normal. The stock market has gone through recessions, crashes, and global crises, yet it has always recovered to reach new highs. Selling in a panic locks in losses, while those who stay invested see their money grow over time. Successful investors don't react emotionally, they trust the process. Another psychological trap is chasing short-term gains. It's tempting to jump on the latest hot stock or cryptocurrency, hoping for quick profits. But investing isn't gambling, it's a long-term game. The best investors focus on slow, steady growth instead of trying to get rich overnight. Wealth is built by staying invested, not by constantly buying and selling. One of the biggest mistakes beginners make is checking their portfolios too often. The more frequently you look at your investments, the more likely you are to react emotionally. Daily market fluctuations are meaningless in the long run. Instead of watching the market every day, set a schedule to review your investments once a month or once a quarter. Less stress, better decisions. Another challenge is loss aversion, the tendency to fear losses more than we appreciate gains. Studies show that losing $100 feels twice as bad as gaining $100 feels good. This is why many people panic when they see their investments drop. But here's the truth: short-term losses don't matter unless you sell. If you stay invested, those losses are just temporary paper losses, not actual money lost. Some investors struggle with overconfidence, believing they can predict the market or outsmart professionals. The reality? Even the best investors in the world can't consistently pick winning stocks or time the market. The most reliable strategy is simple: invest in low-cost index funds, keep contributing, and stay patient. Another mindset shift is understanding that investing isn't about timing, it's about time in the market. Many people wait for the perfect time to invest, afraid of buying at a peak. But studies show that even if you invest at the worst possible times, you'll still come out ahead if you stay invested long enough. The sooner you start, the more time your money has to grow. Building wealth is also about ignoring noise. The media loves dramatic headlines about market crashes, recessions, and economic doom. If you react to every scary news story, you'll never invest with confidence. The truth is that the market has survived world wars, financial crises, and pandemics. The best response to fear: stick to your plan. Another common struggle is comparing yourself to others. Seeing friends or social media influencers brag about making money from risky investments can make you feel like you're missing out. But those stories rarely show the full picture. People highlight their wins, not their losses. Your investment strategy should be based on your goals, not someone else's hype. The key to long-term success is discipline. Set up automatic investments, ignore short-term noise, and remind yourself why you started. Investing is like a marathon, not a sprint. There will be ups and downs, but those who stay the course are the ones who build real wealth. Now that you understand the psychology behind investing, the next chapter will show you how to prepare for market crashes, why they aren't as scary as they seem, and how to turn them into opportunities. Chapter 10. Before you invest, fix these financial roadblocks first. Investing is one of the best ways to build wealth, but before you start, you need a strong financial foundation. Too many people jump into the stock market without preparing, only to find themselves withdrawing money at the worst time. The truth is, successful investing starts before you invest a single dollar. Here's how to fix the biggest financial roadblocks holding you back. The first step is paying off high-interest debt. If you're carrying credit card balances with 20% interest, investing won't help. You're losing more than you can gain. Imagine earning an 8% return in the stock market, but paying 20% in interest on your debt. That's a losing game. Before investing, prioritize paying off any debt with interest above 7 to 8%. The sooner you clear your balances, the faster you can grow your wealth. Next, you need an emergency fund. Life is unpredictable, cars break down, medical bills happen, and jobs aren't always secure. If you don't have savings, you might be forced to sell your investments during a downturn. A good rule of thumb is to have 3 to 6 months' worth of expenses in a separate savings account. This ensures you can handle emergencies without touching your investments. Another overlooked factor is understanding your risk tolerance. Everyone has a different comfort level with market fluctuations. If a 10% drop in your portfolio makes you panic, you may need a more conservative strategy. On the other hand, if you can ignore short-term drops and stay focused on long-term gains, you can afford to take more risk. Investing is about finding the right balance between growth and stability based on your comfort level. You should also create a budget that allows for consistent investing. Many people say they can't afford to invest, but in reality they don't track their spending. Take a close look at where your money is going each month. Cutting out small, unnecessary expenses can free up money for investments. Even if you start with just $50 a month, the key is building the habit. Another mistake is not having clear financial goals. Are you investing for retirement, buying a home, or building general wealth? Your goals determine your strategy. Retirement accounts like 401ks and IRAs are great for long-term growth, while taxable brokerage accounts offer more flexibility. Knowing your goals helps you choose the right investment vehicles. Before investing, make sure you're taking full advantage of employer benefits. If your job offers a 401k match, contribute enough to get the full match. It's free money. Many people leave thousands of dollars on the table each year by not maximizing their employer's contributions. If you don't have a 401k, consider opening an IRA to get tax advantages. Another crucial step is understanding investment fees. Many people invest in mutual funds with high expense ratios, not realizing how much they're losing in fees. A fund with a 1% fee might not sound bad, but over decades it can cost you hundreds of thousands of dollars. Always choose low-cost index funds and ETFs with expense ratios under 0.1%. Keeping costs low means more of your money stays invested. Some people hesitate to invest because they think they need a perfect plan before starting. The reality? It's better to start small and adjust as you go. The perfect moment never comes, and waiting only costs you valuable time in the market. Once you have a solid financial foundation, the best thing you can do is take action. By fixing these roadblocks now, you'll set yourself up for success. Investing works best when you can leave your money alone to grow. If you're constantly withdrawing funds, you'll miss out on the true power of compounding. Now that you've prepared your finances, the next chapter will show you what to do when the stock market crashes, why panic is your worst enemy, and how to turn downturns into opportunities. Chapter 11. What to do when the market crashes. Hint: don't panic. Market crashes are scary. Watching your investments drop in value can make you feel like you're losing everything. But here's the truth: market crashes are normal. They happen regularly, and every single time, the market has recovered and reached new highs. The worst thing you can do is panic sell when prices drop. The best thing? Stay calm, stay invested, and take advantage of opportunities. The first thing to understand is that market drops are temporary. The stock market has seen crashes, recessions, and global crises, yet, over time, it has always trended upward. The S&P 500, for example, has averaged an 8 to 10% return per year, despite countless downturns. Higher investors who stayed the course reaped the rewards. Those who panicked and sold locked in their losses. Many beginners think, I should sell now and buy back when the market is better. That's a mistake. No one can accurately predict the bottom. If you sell, you're likely to miss the recovery, which often happens fast. The biggest gains in the market usually occur right after a crash. If you miss just a few of these best days, your long-term returns suffer. The key is to stay in the market no matter what. Instead of fearing crashes, smart investors see them as opportunities. When stock prices fall, everything is on sale. If you're still investing regularly, you're buying stocks at discounted prices. Over time, these lower-cost investments will generate even higher returns when the market rebounds. One of the best strategies to survive a market crash is dollar-cost averaging. This means you invest the same amount consistently, whether the market is up or down. By sticking to a schedule, you remove emotion from investing and take advantage of lower prices when they happen. Another key to surviving downturns is having a strong financial foundation. If you've built an emergency fund and avoided high-interest debt, you won't need to sell investments when times get tough. Market downturns only hurt investors who are forced to withdraw money at the wrong time. If you can leave your investments alone, you'll come out ahead. It's also important to turn off the noise. News headlines are designed to create fear. During a crash, the media makes it seem like the world is ending. But if you look at history, every crash has been followed by a recovery. If you focus on long-term results instead of short-term panic, you'll make better decisions. One mistake many investors make is checking their portfolios too often. Watching your investments drop daily can make you feel anxious and tempted to act. The best strategy is to set it and forget it. If you have a long-term plan and automatic investments, there's no need to check the market constantly. Reviewing your portfolio once a quarter is more than enough. Another way to protect yourself during downturns is staying diversified. If all your money is in a single stock, a crash could wipe you out. But if you're invested in broad index funds, you own hundreds of companies. Some may struggle, but others will thrive, balancing out your risk. Diversification ensures that no single event can destroy your portfolio. Market crashes test your patience, but they're not the end of the world. If you have a long-term mindset, downturns become opportunities instead of disasters. The most successful investors aren't the ones who avoid crashes, they're the ones who stay invested and keep buying during them. Now that you know how to handle market downturns, the next chapter will focus on how to keep growing wealth over time and create a lifetime strategy for financial success. Chapter 12. Your next steps. How to keep growing wealth over time. Investing isn't something you do once and forget. It's a lifelong process that requires patience, consistency, and small adjustments along the way. The good news? Wealth building gets easier over time. Once you have a system in place, your money starts working for you, and all you need to do is stay the course. The first step to long-term success is sticking to your investment plan. It's easy to get distracted by the latest stock market news or feel tempted to change strategies when others brag about quick profits. But remember, the best investors don't chase trends. They follow a simple, proven strategy and let time do the heavy lifting. Another key to long-term investing is continuously increasing your contributions. As your income grows, your investments should grow too. If you started with $50 a month, try increasing it to $100, then $200. Small increases may not seem like much, but over decades, they make a massive difference. The more you invest early, the less you have to worry about later. One of the smartest moves you can make is automating your finances. Set up automatic transfers from your bank account to your investment accounts so that investing happens without you thinking about it. Automation removes emotion from the process, ensuring that you stay consistent even when the market fluctuates. It's also important to periodically review your portfolio. While you don't need to check your investments daily, reviewing them once or twice a year helps you stay on track. Make sure your asset allocation still fits your goals. When you're young, you might be mostly invested in stocks, but as you approach retirement, shifting to a mix of stocks and bonds can help protect your wealth. As your wealth grows, diversification becomes even more important. While index funds are a great foundation, you may want to expand into other asset classes like real estate, bonds, or international funds. Diversifying across different investments reduces risk and helps your portfolio stay strong through all market conditions. Another long-term success strategy is avoiding lifestyle inflation. As people earn more, they tend to spend more. While it's fine to enjoy your success, increasing your investments instead of unnecessary spending will pay off far more in the future. Many wealthy people stay rich not because they make a lot, but because they consistently invest a large portion of their income. One mistake to avoid is ignoring tax advantages. If you're not maxing out your 401k or IRA, you're leaving money on the table. These accounts grow tax-free or tax-deferred, allowing your investments to compound faster. Once you've maxed out retirement accounts, consider opening a taxable brokerage account for additional investing. It's also crucial to stay informed but not obsessed. The best investors keep learning but don't let daily news dictate their actions. Reading books, listening to finance podcasts, and following trusted financial experts will help you refine your strategy without overwhelming you with information. Finally, the most important part of building wealth is staying patient. Investing works best when you give it decades to grow. There will be market crashes, recessions, and uncertainty, but those who stay invested always come out ahead. The key is to focus on your long-term vision and not get distracted by short-term noise. You now have everything you need to take control of your financial future. You've learned how to start investing, where to put your money, how to avoid costly mistakes, and how to stay consistent for life. The next step? Take action. Open your investment account, set up automatic contributions, and start building wealth today. Your future self will thank you. Take care and be well.